Warren Buffett is a name synonymous with successful investing. He's considered one of the greatest investors of all time. Buffett was born in Omaha, Nebraska in 1930. His interest in investing began at a young age. He bought his first stock when he was just 11 years old. Buffett studied business and investing at Columbia University. He learned from the legendary Benjamin Graham, the father of value investing. After graduating, Buffett started his own investment firm, Buffett Partnership, in 1956. He quickly gained a reputation for his sharp mind and even sharper investments. He steadily grew his wealth. His investment philosophy focused on identifying undervalued companies with strong fundamentals. This approach proved incredibly successful. In 1965, Buffett took control of Berkshire Hathaway. It was originally a struggling textile company. He transformed it into a multinational conglomerate. Berkshire Hathaway became the vehicle for Buffett's investment success. It acquired major stakes in companies like Coca-Cola, American Express, and Geico. Buffett's investment philosophy, characterized by patience, discipline, and a long-term perspective, has earned him the nickname the Oracle of Omaha. He advocates for investing in what you understand. He stresses the importance of ignoring market noise. His consistent success and folksy wisdom have made him a global icon. People hang on his every word. Investors scrutinize his every move. Buffett's influence extends far beyond Wall Street. He is a renowned philanthropist. He has pledged to give away the majority of his wealth to charitable causes. Diversification is a fundamental principle in investing. It's like an insurance policy for your portfolio. The basic idea is simple. You don't want to put all your money into one stock or one asset class. Why? Because if that one investment does poorly, you could lose a lot of money. Imagine you put all your money into a single company. That company makes a popular gadget. Everyone is buying it. Your investment soars. You feel like a financial genius. But then, a competitor comes along. They create a better gadget. Suddenly, the company you invested in sees its sales plummet. Your investment takes a nosedive. Diversification aims to mitigate this risk. By spreading your investments across different companies, industries, and asset classes, you reduce the impact of any single investment on your overall portfolio. Think of it like this: you're spreading your risk. If one investment performs poorly, others may perform well, cushioning the blow. This balanced approach helps to smooth out returns over time. It can lead to more consistent long-term growth. It's important to note that diversification doesn't guarantee profits. It's not a magic formula for getting rich quick. However, it does provide a level of protection against major losses. It's a strategy for weathering market ups and downs. This is particularly important for individual investors who may not have the time or expertise to constantly monitor their portfolio. For most investors, diversification is a sound strategy. It provides peace of mind. It helps them stay invested for the long haul, which is crucial for building wealth over time. However, Warren Buffett, the Oracle of Omaha, holds a slightly different view on diversification. His approach challenges conventional wisdom, sparking debate and intrigue within the investment community. Warren Buffett isn't a fan of excessive diversification. He believes investors should own a small number of companies that they understand deeply. This concentrated approach goes against the grain of traditional investment advice. Many financial advisors recommend holding dozens, if not hundreds, of stocks to minimize risk. Buffett argues that true diversification comes from deep knowledge. He believes that by focusing on a select few businesses you understand, you're better positioned to assess their long-term prospects. This allows you to make more informed investment decisions. It's about quality over quantity. Buffett's investment philosophy centers on the idea of circle of competence. He stresses the importance of investing only in businesses you understand. When you operate within your circle of competence, you can analyze companies effectively. You're better equipped to identify undervalued opportunities. This level of understanding requires focus. It means resisting the temptation to chase every hot stock tip or invest in trendy industries you know little about. Buffett believes that spreading yourself too thin across numerous investments dilutes your focus. it prevents you from truly understanding the businesses you own. Section 3. Circle of Competence. Buffett's concentrated approach stems from his strong conviction in his investment choices. He thoroughly researches companies before investing. He looks for businesses with a durable competitive advantage. He wants companies with strong management teams. Once he invests, he's willing to hold for the long term, often years or even decades. His patience and conviction allow him to ride out market fluctuations. He benefits from the compounding effect of long-term growth. Section 4. A word of caution, not for everyone. It's crucial to acknowledge that Buffett's approach is not for everyone. His concentrated investing style requires a high degree of expertise, patience, and risk tolerance. It's not suitable for investors who panic easily during market downturns. It's not ideal for those who lack the time or inclination to conduct thorough research. Buffett's success is also a product of his unique access to information and his ability to influence the companies he invests in. Individual investors typically don't have these advantages. While his concentrated approach has served him well, it's essential to consider your own investment goals, risk tolerance, and time horizon before attempting to replicate his strategy. Section 1. A concentrated portfolio, Buffett's holdings. Warren Buffett's investment portfolio at Berkshire Hathaway is a testament to his philosophy of concentrated investing. As of early 2023, Berkshire Hathaway's public stock portfolio holds over 40 different stocks. This might seem like a lot, but a closer look reveals a striking concentration. The top 5 holdings, Apple, Bank of America, American Express, Coca-Cola, and Chevron, account for over 75% of the portfolio's total value. This high level of concentration reflects Buffett's conviction in his investment choices. He's willing to bet big on companies he believes in. Section 2. Apple, a bite of tech. Take Apple, for example. Berkshire Hathaway began accumulating shares in the tech giant in 2016. At the time, Apple was already a well-established company. Some questioned whether it could maintain its growth trajectory. Buffett, however, saw Apple as more than just a hardware manufacturer. He recognized its powerful brand, loyal customer base, and impressive cash flow. Today, Apple is Berkshire Hathaway's largest holding, accounting for a significant portion of its portfolio value. Section 3. Bank of America, a financial fortress. Another example is Bank of America. Buffett began investing in the bank during the 2008 financial crisis, a time when many investors were shunning the financial sector. He saw an opportunity to invest in a well-managed bank with a strong market position at a time of deep pessimism. His bet paid off handsomely. Bank of America has since recovered, and its stock price has appreciated significantly. Buffett's willingness to invest against the tide based on his assessment of a company's intrinsic value is a hallmark of his investment approach. Section 4. Coca-Cola, a classic example. Coca-Cola is a classic example of Buffett's long-term investment horizon. Berkshire Hathaway began acquiring shares in the beverage giant in 1988. Buffett was attracted to Coca-Cola's strong brand recognition, global reach, and consistent profitability. Despite facing challenges over the years, such as fluctuations in commodity prices and concerns about sugary drinks, Coca-Cola has remained a core holding in Berkshire Hathaway's portfolio. This demonstrates Buffett's commitment to holding onto companies he believes have enduring competitive advantages, even if they face short-term headwinds. Section 5. The Power of Concentration Lessons from Berkshire Hathaway. These examples highlight the power of concentration in Buffett's investment strategy. By focusing on a relatively small number of companies he understands well, Buffett can dedicate the time and resources necessary to make informed investment decisions. He can patiently wait for the right opportunities. He can hold his investments for the long term, allowing the power of compounding to work its magic. While his concentrated approach might not be suitable for everyone, it offers valuable lessons for investors of all levels of experience. Section 1. Finding your number, it's not one size fits all. So how many stocks should you have in your portfolio? There's no magic number. Warren Buffett's approach suggests it's better to have a concentrated portfolio of companies you understand well. This might mean owning as few as 10 to 20 stocks. This approach may seem daunting, especially for new investors. Don't worry, you don't have to become the next Warren Buffett overnight. Start by focusing on your circle of competence. What industries or businesses do you know well? What products or services do you use regularly? Understanding a company's products and services is a good starting point for researching its financials and competitive landscape. Section 2. The importance of understanding. Remember, investing is not a game of picking random stocks. It's about owning a piece of a business. Take the time to understand the businesses you're investing in. Read their annual reports, follow their earnings calls. The more you understand a business, the better equipped you'll be to assess its long-term prospects. Don't be afraid to start small. You don't have to invest in every company you find interesting. Focus on finding a few high-quality businesses you believe in. Once you've invested, be patient. The stock market can be volatile in the short term. Don't panic sell if your stocks drop in price. Remember, you're investing for the long haul. If you've chosen your investments wisely, your companies should weather the storms and deliver solid returns over time. Investing like Buffett requires discipline. It's about ignoring the noise and focusing on the fundamentals. It's about having the conviction to hold on to your investments even when the market gets choppy. The financial media thrives on sensationalism. They often exaggerate market movements. Don't let their headlines dictate your investment decisions. Remember, you're not investing in headlines, you're investing in businesses. Focus on the long-term health and profitability of the companies you own. Tune out the noise and stay focused on your investment goals. Buffett's wisdom extends beyond stock picking. He emphasizes the importance of living below your means, avoiding debt, and investing consistently over time. These principles are universal. They apply to investors of all levels of experience. Warren Buffett's investment philosophy might seem counterintuitive in today's fast-paced world. We're bombarded with information. We're constantly urged to buy the latest hot stock. It's easy to get caught up in the frenzy. However, Buffett's approach reminds us that investing is not about chasing quick riches. It's about building lasting wealth through careful research, patience, and a long-term perspective. His emphasis on understanding your investments, focusing on quality over quantity, and tuning out market noise are as relevant today as they were decades ago. Buffett's success is not a fluke. It's the result of a disciplined approach to investing that focuses on identifying undervalued companies with strong fundamentals and holding them for the long term. His principles are applicable to both novice and seasoned investors. It's never too early or too late to start investing like Buffett. Start by educating yourself. Learn about different investment strategies. Explore various industries and businesses. Develop your own circle of competence. Remember, investing is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and being patient. It's about building a portfolio that aligns with your individual goals, risk tolerance, and time horizon. Don't be afraid to seek help from financial advisors if needed. They can provide valuable guidance and support throughout your investment journey. The most important thing is to start investing. The sooner you begin, the sooner you can harness the power of compounding and work towards achieving your financial goals. Warren Buffett's legacy extends beyond his investment acumen. He's a philanthropist who believes in giving back to society. He's a role model who demonstrates the importance of integrity, humility, and hard work. By adopting his principles of investing and living, we can all strive to build a better future for ourselves and generations to come. Remember, investing is not just about making money, it's about making a difference.